Good afternoon, everybody, and thank you very much for joining us today for this session. I want to welcome you all and also welcome our excellent panel today, which is Peter Tutton from StepChange, Shada Elmi from the Aspen Institute's Financial Security Programme, and my colleague Joe Phillips from Nest Insight. So as hopefully many of you will be aware already, today we published some new research, which is available to read on our website and is also available as a handout in the webinar platform. It's the third in a series of insight reports emerging from our sidecar savings trial. And alongside it, we've also published a landscape review of other evidence that relates to emergency saving today. Because we've got such a great panel, I don't want to spend too long talking about the research, although Joe's going to talk a bit more about some of the key findings from it in her comments. But please do go to the website, find that research, take the time to read it. There's all the rest of our sidecar research publications are there as well. So before I hand over to the panelists, I'm just going to talk for a couple of minutes just to give a little bit of introduction to people to our sidecar savings work. I think a lot of the people who've joined us today will be familiar with that work, but just for those who aren't, so Gwen, if you could forward on to the first slide, please. So for those of you who are not so familiar, so our sidecar savings trial is a trial of a hybrid emergency saving and retirement savings tool, which we call JARS in a number of UK workplaces. It's supported by, I want to say, huge thanks to the BlackRock Charitable Trust, the JP Morgan Chase Foundation, and the Money and Pension Service, whose support, including funding for the trial, makes it possible. The goal of the trial is to create an evaluation of the impact on savings behaviours and financial well-being of offering the JARS tool, which we've done by designing a research programme in collaboration with our academic partners and the Money and Pension Service. The technology partner for the trial is Salary Finance, and the savings account that sits behind Salary Finance is provided by the Yorkshire Building Society, and then it works and sits alongside whichever pension arrangement is in the workplace of the employer that we're working with. And JARS is currently available in 5 UK employers, so that's BT, StepChange, Timpsons, University of Glasgow, and as of just the last month or so, ITV. Next slide, please, Gwen. Thank you. So it's what we refer to as a 2-account payroll deduction model. So in effect, it's the standard pensions payroll deduction plus a separate payroll deduction into emergency savings account, but with an automatic rollover feature sat in behind that means that when people's contributions to the emergency account reach a certain threshold, they flip over and become additional pension contributions over and above the automatic enrolment minimums already going into the pension scheme. It works as a workplace benefit offered by employers to their employees. It's completely voluntary on an opt-in basis for employees. The users sign up for a dedicated Salary Finance webpage or via their employee benefits platform. And when they first log on, the user sets a couple of key parameters to how much they're going to contribute each pay period and what they want their target to be, above which the rollover into the pension will take place. And as I said, this is very much designed to be a robust evaluation research project. So what we're trying to explore is whether creating a link between short-term emergency liquid savings and longer-term liquid pension savings creates a kind of a good or appropriate balance of overall liquidity for savers, and in the process is able to enhance their overall financial well-being. So we're particularly interested in measures around how many people sign up, who are they, how do workers use the account once they've signed up, and over the longer term, does the sidecar model have a positive impact on their financial resilience and on their longer term retirement prospects? And we're excited today. Joe will be talking about some of our early insights into some of these questions for the first time. So we're excited to be able to share some of that with you today. So that was a quick kind of reminder for those of you who needed it about what the sidecar trial is. And I'm now delighted to be able to hand over to the first of our speakers, Peter Tutton from StepChange, the debt charity. So Peter, over to you.
Thanks, Will. Hello, everyone. Good afternoon. So I was asked to talk about 3 things: need for emergency savings, and a little bit about sort of where we're seeing COVID impact, and a little bit about why we're involved in the sidecar trials. So I come from StepChange Debt Charity, as our name suggests, we advise people with debt problems right across the UK. Perhaps go to the next slide. Fantastic. So as debt charity, we see the harm that problem debt causes. So we are concerned about low levels of financial resilience among many UK households. And for us, financial resilience means being able to cope with an income or expenditure shock without falling into debt, or you having to use unsustainable credit to cope. Give some idea of the scale of low financial resilience. In February 2020, just before lockdown, first lockdown, the FCA Financial Lives Survey found something like almost 24 million adults, 45%, unable to cover living expenses for 3 months if their income fell, lost their income, or having unsustainable credit commitments, such as using high-cost credit for day-to-day living expenses. So you put these two things together, low ability to cope with shocks and using credit as a safety net, and you get a very powerful driver of serious debt problems. So about 7 in 10 StepChange clients say a main trigger of their debt problems is a life event like unemployment or illness. And a report we did a little while ago called Life Happens found that actually these life shocks are pretty common. Almost half of adults saying someone in their household had experienced a negative life event in the previous 2 years. And those that did experience a negative life event that affected their income were 3 times as likely to be in problem debt as those that did not. However, the likelihood of a budget shock leaking to problem debt, it's not a straight relationship. It's conditioned by the coping strategies people have available to them. So we found that 35% of those people using an overdraft or credit cards to cope with an income or expenditure shock were in problem debt. And that went up to 53% of those who were using high-cost credit. In contrast, only 13% of those who had a savings buffer and were using that to cope with the budget shock were in problem debt. So having a savings buffer really matters. We did some research a while ago suggesting that if a buffer of £1,000 of accessible savings would reduce the chances of someone being in debt by about 44%, which equates to something like 500,000 fewer people being in debt at the moment if we all had that kind of savings buffer available to us. Of course, the challenging bit here is that the vulnerabilities that make that savings buffer so important are the same vulnerabilities that can make it harder for people to save. And here, note that sort of 1/3 of our clients have negative budgets at the time they come to us for advice, and that conditions their sort of outcomes and ability to save and cope with shocks for at least 15 months later, which is as far as we've tracked some clients so far. And even 15 months after advice, only 9% of people who've been through debt advice said they had enough money put aside to replace a fridge or washing machine in an emergency. Although more encouragingly, 20% said they were close to achieving this. So people can save, but it takes time to build it. And also people with lower and more insecure incomes are likely to be more vulnerable to repeated income or expenditure shocks that will erode their savings. So that's kind of where we are now. Let's go to the next slide, please. So has the pandemic reinforced these vulnerabilities? So our research finds about 14 million adults experiencing an income fall affecting their ability to meet day-to-day costs as a result of the pandemic. Most affected were the self-employed, people with insecure work and part-time workers. The most infected groups included renters, particularly young renters, children, parents with children under 5, people from Black, Asian and minority ethnic communities, and working age single adults. And if anyone saw the IFS stuff that was in the news this morning, came to some very similar conclusions on who's been most impacted. So we estimate about 6 million people experiencing financial difficulties, such as falling behind on household bills as a result. Paradoxically, demand for debt advice people coming to us has been lower than we would have otherwise expected without the pandemic. And if you look at the IFS stuff, it tells this story about how support has helped, but it's not helped everyone. So you stick 400 odd billion into the economy and you'd expect some people to be protected against debt. And certainly COVID's protections seem to have supported some people against debt problems that would have happened without the pandemic, while another group of people are certainly being pitched further into financial difficulties and debt. Alongside this, a lot has been made about households building up savings through the lockdown, and sort of huge figures, aggregate figures of household savings, because those people have got reduced expenditure, have been able to build up. And that means there is an opportunity for some people who have built up savings, who may be otherwise vulnerable to debt, to build up a buffer against future shocks, which is maybe something we can think about. But there seems to be a 2-speed impact here as well. So when we looked at our polling, found that about 1/4 of people had an increased ability to save since the pandemic, but a third had a decreased ability to save. So this two-speed thing, and even more particularly amongst those who experienced an income shock because of COVID, their ability to save, 60% had a decreased ability to save. So the idea that the pandemic is reinforcing those financial vulnerabilities we saw before, that seems to be what's going on. Final point on that, interesting, there was a report from Centre for Cities recently that looked at kind of savings and debts, and found that COVID savings have mostly accumulated in cities and large towns in the south of England, while people in cities and large towns in the north and the Midlands are more likely to have been pushed into debt. So with that kind of levelling up agenda going on in the background, COVID and the things we're talking about today about savings and financial resilience is an important part of that, we hope. Finally, final slide, please. So just a very quick bit about why we joined the sidecar trial. So we've been arguing for sort of sidecar accounts for a while, the idea that using the auto enrollment defaults that have been very successful in getting pension saves, sort of the proportion of people saving into pensions up, if you could divert some of that into precautionary savings, it's a sort of double bubble. Not only are people saving for the future, but it gives them that precautionary saving buffers now. So let's see if we can use that that default to help with precautionary savings. There's also a debate about employers' role in promoting final health that needs exploring more, so we thought the pilot was a good thing on that. And finally, because we've been banging on about it and we've been bothering the minister, Guy Opperman, on it, he pointed his finger and said, well, are you going to join the trial StepChange? So we couldn't really say no, and that's me.
Great, thank you, Peter, for that. That was really great set of comments. So I'm now going to hand over to Shada Elmi from the Aspen Institute's Financial Security Programme, who I think is going to talk a bit about their work on the cycle of savings. So Shada, over to you.
Thanks, Will. I'll just be building off of a lot of what Peter was just saying. So I'm Shada Elmi. I'm the Research Program Manager at the Aspen Institute Financial Security Program, and I'm so pleased to be here to share some of the top-level findings from our recent paper about the cycle of savings, which is really connected to the work that you all are putting out today. So all of this was based on insights and research that we did with our Consumer Insights Collaborative, or the CIC. So I'll just take a quick minute to tell you a little bit about them. The CIC is an effort across leading nonprofits that do work with financial empowerment services to help low and moderate income customers across the United States. So in my role at Aspen, I get to work directly with all of them to surface insights about the financial lives of the members and the clients that they work to serve, and the kinds of product, policy, and programmatic solutions that can help support the financial well-being of households. So what happened for us was we were discussing how our CIC partners try to measure savings, and in that conversation, they raised that too often the way that we talk about savings, or the way that funders were asking them to report their program success with helping people save, was missing this dynamic effort that their clients and their members were taking to create their own savings buffers. And so it was this kind of missing connection that led us to write about what we ultimately termed the cycle of savings. Next slide, please. So the cycle of savings is this ongoing act of building, using, and replenishing savings that strengthens both financial resiliency against the shocks that Peter was just talking about, but also allows families to invest in family well-being and economic mobility. Next slide. So in other words, this cycle of savings is really dynamic. It frames savings as something that people are interacting with. The savings are protective. They represent both a personal safety net of unrestricted cash, money that people can use for any purpose. But using liquid savings to address needs is also the safest and the cheapest option for families, which is especially important for those households that have that don't have a big buffer between the income and the expenses that they have coming in. And so these short and medium-term savings can also be mobility enhancing. They support families' ability to invest in themselves, whether that's through education or entrepreneurship. And when we reframe savings in this way, we see that this type of savings is really complementary to the types of long-term savings that we hope that households are also able to build. But it also helps them to continue to progress towards their financial goals, even in the face of these financial shocks. which, as Peter said, are really common. So maybe shocks is not the right word, maybe unexpected, are not quite the right thing, because it happens often. Next slide, please. So given all of what I just said, how is a cycle of savings different from other savings concepts? So on the right-hand side, you'll see this kind of dominant narrative on savings that often focuses on a mostly unidirectional flow of money into savings, people contributing an amount to a stock that continues to grow over time. That's the kind of long-term traditional model of savings that's over a years-long time horizon. This is what we're hoping that people are able to do during one's working years to build up their retirement savings, for example. The reality is that for many households, savings are more interactive. The time horizon they're using is shorter term. And so on the left-hand side, you'll see that cycle of savings where the savings are meant to be drawn down when something comes up unexpectedly, or used towards a specific goal once they hit that goal, and then replenished as the individual can once again contribute to it. So it plays a role as the financial buffer and is also available for families to continue to make progress on the goals that they have. And so you'll see that this is more erratic. It's going up and down. There's bigger dips and spikes as the time horizon goes on. We can go on to the next slide, please. So given the conversation today, just wanted to spend a quick moment just talking about emergency savings. So emergency savings are that kind of short-term savings people use for those shocks, big and small, things that come up unexpectedly, or you expect a car or an appliance repair every so often, but potentially there's a sudden drop in income or an unexpected medical emergency. So these are savings that can help smooth any kind of volatile income too. And the cycle of savings does encompass this emergency savings concept, but it's not just emergency savings. It also refers to that money for those short and medium term goals, like going on a trip or potentially starting your own business. So we can think of emergency savings as that foundational first order need, something that you need to be able to deal with those shocks that come up. But also it's about the comfort of knowing that you have money set aside when things happen. The beauty of savings and cash generally, right, is that this is fungible. It's available for other things than perhaps what the person has labeled it for in their minds. You've set it aside for one thing, but it can be used for something else. And this is the flexibility, the dignity, and the freedom that cash represents, and why these savings are so powerful. It can address when, the kind of when everything goes wrong piece of it, but it also, beyond that, can be used. And what we see in cash transfer research is cash allows people to take other risks, like search for jobs that are more stable, have better hours, might be closer to home, and have benefits associated with them. Next slide, please. So the last concept I just wanted to talk about is, great, all of those things, how do we actually measure this? So I talked earlier about the Consumer Insights Collaborative and why they were so interested, and partially it was because they were asked to report success metrics about how their programs were doing. But the problem is here, like, obviously, if you're just setting it aside and you can look at it in a point in time, it's easier to measure, but you are losing that big story that we're trying to talk about here today. So because of this, we were talking about additional ways that we might be able to illustrate the many benefits of being able to engage with these savings and in this pattern of building up, drawing down, replenishing. In our report, we discussed 4 different ways to do this to create a more holistic picture, which does include a little bit more complexity in the measurement. So are people able to build and replenish savings when their cash flow allows? So that's looking a little bit more closer at their transactions. Using savings to maintain resilience, avoid material hardship, move forward on other goals. Are they able to deploy their savings when they actually hit those goals? And then are they able to avoid expensive forms of debt? And lastly, are they avoiding tapping into that money that is being used or ideally is being set aside for those retirement savings? So it should be noted that not everybody has access to these types of products, and not everyone has access to participation in these programs. Not everybody has these great opportunities with their work, and this particularly affects households of color, female workers, in the US at least. These are kind of the people that are often left out of these conversations. And last slide, please. So bottom line, by reconceptualizing savings in this way, we're better able to understand the concerted efforts that people take to create the buffers to move forward on their financial goals. It also highlights the barriers that people face in trying to build these savings, and hopefully demonstrates a direction we can take to help support these efforts. So I'll stop there and I'll turn it back to Will.
Brilliant, thank you so much, Shada. Really great comments, and starting to get some questions here as well. So clearly getting people in the audience thinking as well. So on that note, I'm really happy to hand over to Joe Phillips, our Director of Innovation and Research and StepChange, to talk a bit more about the research that we published today in the light of what Peter and Shada have said so far.
Thanks, Will. Will has already thanked all the many trial collaborators who have worked with us to make this happen, the employers, funders, research partners, delivery partners. Just before I start, I'd also really like to thank the research team who have contributed to this analysis that I'm about to share, especially Peter at Yorkshire Building Society, Shri at Salary Finance, Sarah at Harvard, Alex at BT, the whole team at Britain Thinks, Roxana at MAPS, and Annick and the Nest Insight team. There's a lot of work that's gone into this from a lot of different places and people. These are very early learnings from a research trial that is very much in progress at the moment, and they've clearly been drawn from an extraordinary period of time during the COVID pandemic. And there are just a few limitations to bear in mind as a result. Some of the data that I'm going to share is based just on one employer rather than all of the employers, for example. In some cases, we're looking at quite small sample sizes, and we're only looking at aggregate data in the picture that I'm about to share, whereas later in the trial, we will be able to match individual level data from different sources and look at individual patterns. So as a result, these are preliminary results, and they're likely to evolve and change as we receive additional data and continue our work. But having said that, we've got lots to share here and in the report, and we are really excited to talk through for the first time these insights into how employees are responding to and using a sidecar savings tool in the real world. Can I have the next slide, please, Gwen? So the first thing we wanted to understand in this research was just whether this new idea of a hybrid tool that combines emergency and retirement savings would appeal to people. And we've learned that JARS is widely seen to be a helpful savings tool by employees. So 6 in 10 employees at one employer said they think that JARS could help them when they were shown a description of what JARS is and what it does. And the quotations on the right here from JARS users draw out some of the benefits that employees perceive in this kind of savings tool. The first one is that it's all set up for you, and the quote at the top just talks about the sheer convenience of it. You just click on a few buttons and away it goes. It's already there. I just have to sign up. I don't have to go and do any research, choose between different things. And then the second quotation talks about the payroll deduction mechanism. And I think it's really important that we don't underestimate the power of that. Time and again, we've heard people talking about the benefit of money being taken out of your wages before it hits your pocket, and about that happening automatically once you've set it up. And I think that sort of contributes to the second half of the middle quote, where the benefit is really drawn out of peace of mind. It alleviates the stress and worry about financial situations, knowing that that is happening, and I don't have to remember to do anything or kind of set anything up once I've done the sign up. And the last quote really brings to life that benefit of gaining peace of mind through this kind of saving. No one knows what the future holds, do they? Peace of mind is important, and that confidence and relief of having a savings buffer in place to manage for uncertainty. And clearly there are some indications that is more salient to people post-COVID, as all of us have been coping with different kinds of uncertainty and unexpected events. Can I have the next slide, please, Gwen? So having looked at the appeal of JARS, it's definitely worth saying that JARS is clearly not going to be for everyone, including those who could already be comfortably saving. And when we look at other sources of data, one of the reasons that people don't sign up for workplace savings that they're already saving somewhere else. So it's particularly important to look at whether people who are more financially vulnerable think that JARS would help them. So we saw just now that 6 in 10 employees thought JARS could help them. In this chart, we can see that this rises to 8 in 10 of those who say they're currently struggling with bills and commitments, and to 7 in 10 of those who say they'd struggle to pay an unexpected bill of £300. So JARS seems to particularly appeal to the target audience who may not already have short-term savings to protect them against financial shocks. Next slide, please. But although there are these indications that many employees think that JARS would help them, there is a real gap between intention to save and action. And we can see on the left-hand side of this slide the drop-off in one employee population. So out of every 100 eligible employees, 57 say, I think JARS would help me. 15 say that they plan to sign up now or in the near future, but just 1 follows through. That means that 98% of people who think the JARS would help them don't sign up. And under opt-in conditions for saving, like we have in place in this trial, an employee needs to be aware of JARS. They need to first find out about it. And then if they want to save, they need to remember and make time to sign up to save. And as part of that sign up process, they need to provide some information, including to the savings account provider to open an account. And at every stage of that journey, there's the potential for friction, for drop off, and there are multiple behavioural and structural barriers in play. And all this is summed up better than I've just done by the employee quote at the bottom here. I considered going for it. I don't know why I didn't do it. I didn't get around to it. So having looked at that, the next thing to look at is who is saving in JARS. And the evidence that we have suggests that there's quite a range of ages, of incomes, and that JARS has pretty broad appeal across different demographic characteristics, perhaps broader actually than we might have thought. But what's most interesting here, I think, is the distribution of JARS users according to their financial resilience. And we can look at this using the Money and Pension Services 3 financial resilience segments, which looks at whether people are financially struggling, squeezed, or comfortable. And this chart shows the proportion of JARS users in each of those segments. On the left, amongst JARS users, compared with their incidence in the UK population, and in the bars on the right. So almost half of JARS users fall within the squeezed segment. That's the middle grey bar. This is really encouraging to see. This group has a median household income of £22,500, and it's characterised by having significant financial commitments but relatively little provision to cope with a financial shock. And this is absolutely the target for building emergency savings. We can see from the pink bars that JARS users are less likely to be in the financially struggling group. This group is also less likely to have a buffer, but they've got a much lower median household income of £16,500, and they're characterised as being the most likely to be over indebted. So affordability may be a real barrier to them saving, and it's not surprising to see them under indexing. But it's also interesting to see that around 2/5 of users come from the most financially resilient cushioned group, shown here in the purple bars. And we heard in the qualitative research that we did with employees that JARS can very much be a way for people to start saving for the first time, to take them from being a non-saver to a saver. But also actually amongst people who perhaps are more cushioned, there was still an attraction in saving through JARS, even if they had or were saving in other ways. They saw JARS to be quite innovative and quite easy to use compared to other kinds of saving they've done. So there is quite a broad appeal for different reasons across different groups. Can I have the next slide, please, Gwen? So the next thing we've done is look at how JARS is actually being used in practice. And the first thing to say is that JARS users are saving persistently once they've signed up. So only 2% of emergency savings accounts have been closed, and very few people have paused their contributions. So once people sign up, they generally keep saving. Users talked about how easy they found it to keep saving once that saving is taken out automatically through payroll. And then mostly people stick with the savings amount that they chose per payroll when they signed up to save, and the average is about £100 a month that people are saving. However, 15% of JARS users have made a change to their savings amount, and of these, around 3/4 were increases and around 1/4 were decreases. And in some cases, we have been able to look at individual patterns, and one of the ones that's most encouraging is the sort of individual pattern where someone starts out saving maybe £20 a month, a few months later puts it up to £30 a month, a few months later puts it up to £40 a month, and is building a kind of positive savings habit as they go and making a change once they're sort of comfortable with the amount that they're saving. The other thing we've looked at is whether people are using their savings account outside of payroll to save money. And interestingly, just over 1 in 4 people have made an ad hoc deposit into their account outside of payroll, and the mean value of that is £300. And we also see that 4 in 10 JARS users have withdrawn money from their emergency savings account. I'm going to talk about withdrawals a little more in a minute, but first of all, I just want to note that whilst that set and forget sort of auto savings mechanism seems to be really effective in getting people starting with saving and saving persistently, it's also really encouraging that that doesn't seem to mean low engagement. It's not set and forget I've got savings at all and kind of make no changes to it. it seems to be the case that JARS users are quite actively managing and using their accounts and using that money when they need it and adjusting their savings amounts to different circumstances. Can I have the next slide, please, Gwen? So the next slide looks at withdrawals in a bit more detail. And as Shade has just talked about, people using the money that they save in their emergency savings account is a sign of success. JARS will only work if people use and are protected by their emergency savings when they need them. So we saw just now that 4 in 10 JARS users have made at least one JARS withdrawal, and that's shown here in the left-hand turquoise bar. But we can then break that down in a bit more detail. So we see in the middle turquoise bar that just under a quarter of JARS users have made more than 5 withdrawals. And on the right, just over 1 in 10 JARS users have made more than 10 withdrawals. And to put that in context, most JARS accounts, 8 in 10 JARS accounts, have been open for a year or less. So that kind of goes back to Shader's earlier point that these shocks can happen quite often. People might need this money quite frequently. We can also see, as we might expect, that people who are in that financially struggling segment are the most likely to be making withdrawals, including more likely to be making multiple withdrawals. And we know from the qualitative research that we've done that these withdrawals are being made for a range of reasons, and we're probably starting to see some different usage patterns here. So one is the idea we've been talking about, emergency savings, where you make a withdrawal to pay for a financial shock, where you're managing thin margins between income and expenditure and drawing on this cash reserve. Another pattern we think we might be seeing is more like income smoothing and budgeting, where withdrawals are made to manage ups and downs in a household balance sheet, and those withdrawals are made relatively frequently. So one example we've heard is someone sort of using this to budget for a quarterly service charge, something that doesn't happen monthly that you can put a bit of money aside for. And then we've also heard quite a bit about goal-based savings, where an individual doesn't plan to make a withdrawal until they've reached that goal, saving for a holiday, saving for Christmas presents. But actually, we had quite a few examples of people then having that money in place when the financial shock happens. So it's a bit blurry between the two. And this is an area we want to really continue to explore as we go through the trial, to understand actually what are the patterns and what are the different ways in which short-term savings are used in practice. Can I have the next slide, please, Gwen? So alongside this pattern of savings use, though, where people are withdrawing their savings, we also see that on average, people are building their savings. And here we see mean savings balances rising over time to just over £550 after a year of saving. And that's partly because the average withdrawal is half the account balance. So as Peter said, people can save, and it takes time to build savings, particularly if you're using those savings along the way. But the pattern we're seeing is one of building up savings. And to go back to Shader's patterns, we had the kind of bumpy line and the going straight up line. This is sort of somewhere between the two in a way. It's a bumpy line that is also gradually going up because people aren't withdrawing all of their savings on average. It's a sort of it's a bumpy upward climb rather than a steady upward climb. As we'd expect at this stage, very few JARS users have hit their savings target yet, the point at which their savings amounts start to roll over as additional contributions to their workplace pension. But with balances generally climbing over time, we think it is likely that by the end of the trial, we'll be able to look at this and evaluate the effectiveness of that rollover. Can I have the next slide, please, Gwen? So I just want to close with a statement from one JARS user. This is someone who's in his 30s. He's got a partner and 2 grown-up children. He's been saving £50 a month, and he's used those savings to cover some unexpected bills rather than putting that money on his credit card. And he talks here about the emotional impact of that and the reassurance that building up savings in the background has given him. So he says, JARS has made it a lot easier knowing that I've put money aside for unexpected stuff or just to have in the future, and then what's left is left. There's no worry about trying to find extra money for anything. And I think this is one of a number of early indications of a positive impact of saving through JARS on financial well-being, on people's resilience and on their confidence. And we're really looking forward to continuing to explore and measure this over the coming months. Thank you.
Great, thank you, Jo, and thank you to all 3 of our panelists for some really insightful and thought-provoking remarks. So just a reminder to our audience, please do get any questions in or discussion points that you'd like us to cover. We've got 10-15 minutes now for some questions. I've had a couple in already, and there's a couple of other things I thought I might pick up with the panel as well, but take the opportunity to ask those questions, please, and we'll get to as many of them as we can. So I'm going to start with a question that's coming from one of the members of our audience. So the specific question was, could JARS have three pathways: emergency, debt repayment, and pension savings? But I'm just going to expand it out slightly because I'm conscious that both Shada and Peter talked about kind of other financial priorities than strictly emergency saving and pension saving too. So maybe Joe, I'll start with you and then pass over to the others just on kind of, how much more broadly applicable could this kind of JARS concept be, do we think, in the future?
Yeah, really good question, and that's something that we've thought about quite a bit. I think the debt repayment is really useful to think about, particularly when thinking about people who aren't in a position to save right now and can't afford to save. And certainly one of our employers is looking at whether there is a way to transition people from the point where they finish paying off a loan through their employer to then transitioning that payment into a savings payment at the end of the loan period. The other thing that we've thought about, actually, that wasn't mentioned in the question is somewhere in between short-term and long-term savings. It is a sort of mid-term goal-based savings pot once you've got a buffer in place. I think there are some design challenges there. The money going in can only go so far. I think the hybrid product concept, if smartly designed, helps people manage competing priorities in a smart way and in a way that's sequenced sensibly. But I think there would have to be quite a lot of thought given to design that brings in more elements to that hybrid to make sure that the money just doesn't end up too thinly spread. And I think that's where sort of some of the understanding of people's situation that comes from open banking, being able to look at the whole picture, has really high potential to help then make some sort of more individually smart decisions about where an extra pound should go, in a way that doesn't involve the individual themselves having to kind of weigh up lots of different options in a sort of cognitively heavy, difficult way.
Great, thanks, Joe. And Shada, any thoughts about this?
Yeah, I mean, I agree with everything Joe just said. This is really important, and how to balance all of these competing priorities. Creating programs that actually match the way that people are saving is really critical, and I think that the work that you all are doing is really important in demonstrating different ways that we can think about how to create these savings accounts, how these accounts can talk to each other, and thinking about the ways that we can ensure that the programs that are actually being put in place match the way that people think about their savings, use their savings, or utilizing them. And so I think one thing that I would just add is thinking about user centricity. Something that we often are talking about on my team is making sure that the people that you intend to serve are actually involved in the process of ensuring that programs, products, policies, et cetera, are actually meeting people's needs. So one big finding in our work with the CIC was just how often that is missed. And so thinking about accessibility, making sure that people have immediate access to their funds. Otherwise, it's impractical for people to be able to save with these types of options, being able to access it without penalties or fees. And I think one thing that Joe touched on earlier that I do want to lift up is there's a prevalent issue of how programs like for savings often are talked about, and it can feel like a failure to deploy those savings. So I appreciate the work that you all are doing and encouraging people to say, you have those savings, use them, and then thinking about how to measure again. So when you draw down on savings, making sure that this is a success. You had savings available when you needed it. So there's something to be said about congratulating individuals both for adding to their savings, but also for using them towards their goals. That is a success.
Great, thanks, Shaden. Peter, anything to add on that? You're on mute, Peter.
Sorry. So yeah, no, there's some good thoughts in there. There is provision within certain debt repayment plans for a small amount of money to go into savings rather than go to creditors. Actually, we need to research into that a bit more about how it's working. It's been around for a while, but yeah, see how that happens. And whether in the early stage people are much more focused on sort of debt repayment than savings, and how we revisit that is something I'll go back and look at. I've sort of taken with the this idea about the cycle of savings. So you think what we do in debt advice is debt advice works by kind of putting structure. So people don't have structure in their finances because they have more things than they can repay. So you take some things out and restructure payments, put structure. We tend to have quite rigid nominal budgets, but that saving cycle idea is that actually people's budgets are much more cash flowing, and it's kind of things that go up and down. We're looking at the moment of our clients who are kind of find it most hard to sort of stick, to make ends meet. And there's some insight from your research we'll take on board when we're talking to our clients about how people manage lumpy expenditure on a fixed budget as you go along. So there's an opportunity for that sort of practical saving. What is it that helps people the most? So yes, there's quite a lot in there of different routes. There's a lot to think about in practice about particularly our clients and people recovering from debt, about different strategies to help them manage and sort of how they think about savings.
Great, thank you all. So I've had a sudden influx of the same question from a number of different people, phrased in slightly different ways, but it's definitely one of the most important questions in our minds. So I'll just share it with you all and welcome your views. So the strong theme in the questions around, lots of great data that we're seeing on the use of these accounts, but clearly with the caveat that take up is very low, and I know showed a similar to levels of take up they've been seen in kind of parallel models in the US. So what can be done about driving higher take up in this kind of space? Peter, do you want to go first?
So it's a really good question and not an easy one to answer. I mean, one of the things of the original thinking about sidecar was about how you use the auto enrolment default to a proportion of that money, rather than going into pension savings, goes into a short-term accessible savings pot. So what Joe's saying, that the trial is kind of finding that once people are into that default, it's quite powerful in getting people to start to save and continue to save. Of course, at the moment you can't force people into that default because the way that kind of auto enrolment works, but whether that means, the kind of once people are in it, it seems to be working well, but there's a high dropout rate to get people into it. Is this another question? Like for pension savings, well, that's changed the default, and actually when people are having some money going to short-term saving pot, they'll get some benefits from that. That seems to be perhaps a finding from the trial. I mean, there are some other things I haven't looked in for a little while on what's happening with Help to Save. So Help to Save is another good scheme, a government match scheme to help people save, which is focused on this target audience. There's some questions there about what more could be done. So my understanding from there is it is getting take up, again, not only a proportion of its target audience are taking it up. Those that are taking it up are kind of saving regularly and quite well. But there are some questions there. Government scheme targeted at tax credit and universal credit claimants. Surely that's a captive audience. There's more that could be done to kind of within that system to encourage people to save. So there are bits and pieces to think about there.
Great, thanks, Peter. Shada, driving higher participation. Any brilliant insights that we haven't thought of yet?
Brilliant insights. That's a high bar now. No, I think really automatic enrollment, we're seeing similar take up number issues in the US, especially with the uptake. So the numbers that you are all finding seem on par with what we're seeing. So I think a lot of it is overcoming those initial hurdles to get people to go through the process. Even if it's simple, it's not enough to necessarily get people to join. And in the US, we also have different regulations and laws that can discourage employers from being able to auto enroll into these programs, or state payroll laws that dictate how employers can actually direct payroll for employees. So those are pieces, but without scale and auto enrollment, these can also be expensive benefits to offer because, by definition, they're small accounts that don't necessarily get that big investment return. So there's also a need to think about policy here because banks and others may not join into this without that investment return. And so policy seems to be the direction that we're going to have to be pointing to, at least in the US.
Great, thanks, Shada. And Joe, any final comments on that one?
I mean, I think just to say, as many of the people listening to this will know, that this is an area that Nest Insight is actively looking to explore further. we will shortly be publishing a paper jointly with Yorkshire Building Society, looking at some of those regulatory barriers that Shada's just talked about that are very much here in the UK as well, and what they mean for if an employer wanted to support people to save through an opt-out joining approach. I think, just to be clear, because sometimes I think this is misinterpreted, what we're talking about here is giving people a choice whether or not to save, but making it easier for those who want to save to do so if an employer wanted to facilitate that. And I think sometimes there's language like force and kind of push, and I think all we're talking about here is a behavioural mechanism that supports people who want to save, to make for that to happen for them without them having to overcome all the barriers that we've talked about. And I think what's interesting in this situation is that it could overcome some of the friction barriers in signing up, but also in terms of opening an account and some of the steps to go through there in terms of know your customer checks and anti-money laundering. So we're working with the FCA regulatory sandbox to look at some of that. We are actively looking for interested employers and delivery partners to participate with us in some research to look at what impact does an opt-out approach to joining have in practice amongst an employee population.
Yeah, and I would just add to echo something Peter said, because I think we've focused a lot on the opt-out mechanism and kind of variations on auto enrolment here, but I do think this whole question of financial incentives is potentially a powerful one too. In the landscape review that we published today alongside the paper that Joe's talked about, there's one, albeit quite anecdotal example from the States of a plan that had an upfront financial incentive from the employer that had vastly higher take-up rates than anything we've seen in almost any other kind of opt-in setting. So somewhere in that mix of financial incentives and opt-out mechanisms feels like the kind of sweet spot. We have a reasonably hard stop deadline at 5 to 3, and so unfortunately we're sort of coming to the end. There's been a number of questions that have been asked that are more specific, sort of more information about the data questions. So I would say we'll try and pick up with people who've asked those questions offline, and please do get in touch with us directly through the Nest Insight website if there are specific things about the trial that you people in the audience want to know more about and haven't had a chance to get to. But with that, I think I'm going to just start to bring us to a close. So I want to say an absolutely huge thank you to Shada and to Peter and to Joe for presenting today. Really great comments and great answers to the questions that we had. I also want to just take a minute and say thanks to my colleague Gwen, who, in addition to helping us by running the slides in the background, has remained calm through a few immediately pre-live technical hitches that we had and just kind of kept us on track. So thank you, Gwen, for your sterling work in the background there. I want to reiterate again the thanks to the three funding partners for the project: BlackRock, David Morgan Chase Foundation, and the Money and Pension Service, without whom none of this work would be going on, and also to our delivery partners and the participating employers in the trial. If you have any interest in getting involved in this work in any way, including employers, there is absolutely still opportunities for employers to become involved in the work that we're doing. Please do get in touch with us through the website. Please also go to the website to read the research, read previous papers that we've put out in this space, and get in touch if you have any further questions or comments, or you'd like to talk to us about any of this work in any way. On which note, I think we're going to draw to a close. So thank you again all for joining us today. I hope you found the discussion useful and look forward to hearing from you or picking up with you afterwards. Thank you very much and goodbye.